All right, guys, so one of the few indicators we're going to take a look at in this series is the moving average. The moving average is calculated by taking the price of a given asset over a specific time period. And as new data points emerge, old ones are dropped. And it creates a dynamic line of like support and resistance, basically. And it can give you a very clear understanding of the overall bias of whatever market you're looking at. You don't use them on their own, you use them with context of other key technical factors, but it can be really, 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 really effective when you know how to use it. So without further ado, let's get into it and we'll talk you through over at the charts. All right, guys, welcome. So we've got moving averages, yeah? I'm gonna show you guys where to find it. So obviously at the top, we don't use many indicators. We use the RSI, the moving average. We don't use too many. We don't like to make the charts too busy and, all over the place. With the moving average, it's a really good way to kind of get a vague picture and a vague idea of a trend. What moving averages essentially do, depending on your settings, so you can pick the amount of days you want to take the data from. But what it's essentially doing is giving you a reading of the average price of the asset that you're analyzing over a given time period, and it spits it out in a nice little wavy form. What we're going to do is we're going to pull up an SMA, which is a simple moving average. So just click this one, moving average symbol, that's where you find it, okay? And it's gonna plot on a little line here. We'll move to the daily time frame as well. So what you can see is it's like a line following the market. And essentially the rule of thumb is this, right? If you're trading above, it's like you're trading above support. If you're trading below, it's like you're trading below resistance, essentially. And it's giving you a vague idea and a vague outline of the market's movements. Always remember, indicators lag, essentially. They're not going to tell you which direction the market's going to go in. It's taking data that's already been plotted onto the charts and then giving you the indication. All right. Always remember that with what's it called? Sorry. Always remember that with indicators. Okay. You can edit the settings. So this is a 9-day moving average. If we then put on like a 20, you'll see it changes. It becomes a little bit different, and you can, depending on the sort of viewpoint that you want to see, obviously if you have the amount of days that it's collecting the data is wider, it's going to give you a wider reading, and it's going to be less vague because it's giving you an average of 20 days now of the price of Bitcoin. Okay, 20 days of data of the price of Bitcoin and the change in that price. Okay, very, very simple. Very, very straightforward. Keep it that way. And you would, some traders would use this as like entry and exit points. As you can see, it does get respected. For example, like here, you've seen that it respected resistance there nicely. But realistically, you want to use this as a way to sort of just give you a little bit of reassurance of the trend you're in. What a lot of people do is they might have two on. Let me add another one. So they might add another SMA, right? So they might have two, and they might have like a 20-day moving average or a 50-day moving average and like a 9-day moving average, just so that you can get a better gauge, all right? And you can see it from both perspectives. You can say, right, okay, so over 20 days, I'm seeing that the market is moving and trending higher. And that's also confirmed when looking at it from a shorter period of time as well. It can give you more validation. So that's a simple moving average. What simple moving averages do is it will take, so let's just, let's delete this and let's make it very clear, right? So if we have a 10-day moving average, right? What that's doing, we're on the daily time frame. So what that's doing is it's taking a reading from the last 10 days of price action, and it's giving you an average of the closures of those days, and it's spitting it out in the form of this nice line, and it's telling you which sort of what price is done in them last 10 days. So right now it's relatively bearish, right? Because it's sort of forming like a little bit of a lower lows and lower highs, right? Now we're trading above it. It could suggest that we may have a change in sentiment based upon the average of the last 10 days. Okay, so that's how you would use it. You'd say, right, okay, so now we were trading below this level, below this moving average. Now we've actually begun to trade above it. So maybe now sentiment's changing. And obviously you pair that with other technical factors as well. All right. And then as well, if you wanted to, you could also add another one. So we could say SMA again, and then you can maybe have like a greater number. So you can maybe call it, I don't know, like a 20, and see how it's reflected there as well. And again, yeah, we're actually beginning to trade above the 20 as well. So over the last 20 days, it's actually beginning to reverse as well. So that's how you would use it. So the simple moving average puts the exact same amount of weight on the 20th day or the 10th or the 10th day that it's taken the data from as it is the most recent day. Whereas you have another type of moving average, which is called the exponential. So we'll pull that up now as well. So what we're going to do is we're going to go to here. We're going to put EMA, stands for moving average exponential. And what the exponential moving average does, right? Oh, we put too many on the chart here. So we'll have two. What the exponential moving average does is it puts more weight on the recent day, right? So it gives you a slightly different reading, very similar, but it is slightly different. And let me just try and explain this in the best way possible, right? So if you have 10, wrong tool. If you have, so if you have 10 days of price action, yeah, 10 days of price action, and this is the SMA, okay? SMA, and this is the SMA. Let me make that bigger. So this is the simple. Think simple as just straightforward. And the simple moving average is to grade the value. It was to grade the value of the. So say this is over 10 days. So this is a 10-day SMA. We have 1 day, 2 days, 3 days, 4 days, 5 days, 6 days, 7 days, 8 days, 9 days, 10 days. Yeah, all very equal in size. Yeah, because the moving average, the SMA values each day the exact same in terms of its data readings. Whereas the EMA, so if we do EMA, 10-day, exactly the same, just this is the exponential moving average. So the exponential moving average, let's just do this over here. If you have your little 10-day thing, this day, so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It puts more weight on the most recent days, okay? So it's almost trying to tell you, right, well, the price changes recently are a little bit more important when you're using the EMA, whereas the simple moving average is just the last 10 days of data is equally as important. The EMA does it a little bit differently. It puts more weight on the recent day. So if you have a closure on the most recent day that it's reading you and it was more negative than say this day was more negative than this day, it will give you a tighter reading on price. Very, very simple. All right. The way we would advise to use moving averages is just to help identify what trend that you're in. Okay. That's the way you would use it. Like I say, if we now if we were trading below this level, this line still, we would say that we're relatively bearish. Okay. And that would also align with the fact that, we're forming lower lows, lower highs. But now the fact that we've begun to trade above could suggest a flip in sentiment. Simple as that. Okay. And also as well, you can also say, right, well, we have been trading relatively bullish. Now we're beginning to trade below. So you can use it in a variety of different ways. Okay. But like I said, and like we always say, indicators, they do lag. You want to use them in alignment with the other key technical factors of pure price action and analysis in order to ensure the best success. All right, guys. So indicators are one of them things where some people will use them and some people won't. I personally don't use the moving average all the time, but I will do at points. You can put it on your charts and go and have a play around and see if you enjoy it. See if it's something that you're going to keep and use in your analysis. It's entirely up to you, this one, but it is really important that you understand it. But I hope you enjoy the episode anyway, and we will see you in the next one.